Imagine this, waking up every Friday morning to fresh income hitting your brokerage account, not from a demanding job, but from your smart investments working around the clock. Sounds like a dream, right? Well, it's absolutely achievable. Many aspire to financial independence, having money generate passive income. Traditional savings or fixed income products today offer meager returns. What if you could tap into the stock market through exchange traded funds or ETFs to create consistent, frequent income? We're talking about income so reliable it could literally pay you every single week. This isn't just about growth. It's about cash flow, having liquid funds available more often. Imagine reinvestment potential. We're simply covering weekly expenses, gaining true financial flexibility. We'll explore 4 specific ETFs which, when strategically combined, provide precisely this consistent weekly dividend payout, transforming your financial outlook. While individual ETFs typically pay monthly or quarterly, the magic happens in how we assemble them. Let's delve into these powerful tools. We seek stability and yield, assets that consistently deposit funds. The goal is replicating a steady paycheck earned through smart investment choices. This strategy suits those valuing frequent income distribution, perhaps to budget weekly or for the psychological benefit of seeing regular capital returns. It's a method to turn your portfolio into a diligent, perpetual income-generating machine, always working. This approach feels incredibly empowering, a testament to effective financial planning. Visualize walking past a bank, knowing your investments actively contribute to wealth without constant intervention. First, the JP Morgan Equity Premium Income ETF, ticker JEPI. Incredibly popular, and for excellent reasons. JEPI delivers high monthly income while offering some S&P 500 upside. How? It actively manages, investing primarily in large-cap U.S. equities. Significant income comes from selling ELNs, or equity-linked notes. These derivatives allow JEPI to generate income from options strategies, specifically selling out-of-the-money call options on the S&P 500 index. This creates consistent income, often yielding high single or low double digits annually. JEPI pays monthly, typically early or mid-month. Its objective is lower volatility equity exposure while yielding considerable income. This makes it a fantastic foundational ETF for an income portfolio. For building a weekly dividend stream, JEPI serves as an anchor investment, reliably delivering income on schedule. Fund managers expertly navigate markets to maintain high income. Its consistent monthly payouts are precisely what we need for a dependable weekly strategy. It's a sophisticated income tool. I highlight it as a premier choice for consistent monthly income within our weekly strategy. Observe how JEPI balances growth potential with robust income generation, a delicate but crucial act for long-term financial success. Next, a close cousin of JEPI, the JP Morgan Nasdaq Equity Premium Income ETF, ticker JEPQ. JEPQ applies a similar strategy to JEPI, but its underlying equity exposure is primarily the Nasdaq 100 index. This means JEPQ invests in large-cap growth-oriented tech companies. The Nasdaq 100 offers higher growth potential but also higher volatility. JEPQ aims to mitigate volatility while capturing growth and generating high income via its Nasdaq 100 covered call strategy. Like JPI, JEPQ uses equity-linked notes to sell call options, generating premium income. This results in high monthly dividend distributions, often similar to JEPI, sometimes slightly higher due to Nasdaq's volatility premiums. For investors wanting exposure to innovative, fast-growing companies and consistent income, JEPQ is ideal. It diversifies away from JEPI's S&P 500 exposure, tapping different market segments while maintaining income focus. Combining JEPQ with JEPI IBI builds a robust foundation of 2 strong monthly payers with different underlying assets, diversifying income and smoothing portfolio performance. JEPQ's monthly payment, typically mid-month, aligns perfectly with staggering income. I explain JEPQ as JEPI IBI's growth-oriented sibling, offering a different high-income flavor. This fund provides a compelling blend of technology sector participation and high cash flow, appealing for supplementing income. It's truly a strategic asset. Our third powerhouse, the Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD. SPHD differs from JP Morgan funds, but is equally effective for income. This ETF selects 50 S&P 500 stocks, historically providing high dividend yields with low volatility. Its methodology screens the 75 S&P 500 companies with highest dividend yields over the past 12 months, then chooses the 50 stocks from that group exhibiting lowest realized volatility. The result is a portfolio of high-quality, income-producing companies, more stable during downturns. SPHD pays monthly dividends, typically towards month-end. This makes it an excellent candidate for staggering your income. While its yield might be slightly lower than JEPI or JEPQ's covered call strategies, it offers a different income flavor, rooted in stable companies paying consistent dividends from earnings, not options premiums. This income source diversification is crucial for a robust portfolio. SPHD offers a more traditional dividend investing approach, focusing on fundamental company strength. It's reliable income from established businesses. I see SPHD as the sturdy, predictable leg of our income stool, providing essential stability. It helps smooth fluctuations for more dynamic strategies. Consider SPHD your steady workhorse for dividend income, consistently delivering without higher octane approaches, proving its enduring value. Finally, our fourth ETF, the Global X Nasdaq 100 Covered Call ETF, ticker QYLD. QYLD is known for its very high distribution yield. It employs a fully covered call strategy on the entire Nasdaq 100 index. This means it holds Nasdaq 100 stocks and systematically sells call options on the index, typically at the money or slightly out of the money. Premiums collected are distributed to shareholders as monthly income. QYLD's distributions are very high, often reaching well into double digits annually. However, understand the trade-offs. Selling covered calls, especially at the money, caps QYLD's upside. If Nasdaq 100 rallies significantly, QYLD won't fully participate. Its primary purpose is income, not capital appreciation. This makes it a fantastic income engine, requiring clear strategy understanding. It pays monthly, usually month-end, perfect for our staggered weekly income approach. QYLD powerfully boosts portfolio yield, especially if capital appreciation isn't primary or if market growth is muted. It's a pure income play, delivering consistent cash flow regardless of market direction, though NAV can decline in strong bull markets. I advise understanding QYLD's risks before integrating it significantly. It's a yield machine, trading upside for consistent high income. Think of QYLD as high-octane fuel for your weekly dividend engine, boosting regular payouts. It's a specialized instrument for a specific income goal. Now, here's the magic: how we achieve weekly income. We've identified 4 excellent monthly dividend-paying ETFs: JPI, JPQ, SPHD, and QYLD. Each fund typically pays its dividend at a different time. JPI often pays early to mid-month, JPQ mid-month, SPHD towards month-end, and QYLD also month-end, but often with slightly different dates. By strategically allocating capital across these 4 ETFs, you create a staggered income stream, ensuring a dividend payout almost every week. For instance, if JPI pays first Friday, JPQ second, SPHD third, and QYLD fourth, you effectively receive income every week. The key is researching their specific ex-dividend and payment dates for the current year, as these vary slightly. You're building your own diversified income portfolio, delivering cash flow with remarkable frequency. It's like having 4 employees, each clocking in a different week to deliver your paycheck. This strategy requires upfront planning, but consistent weekly income rewards are substantial. Remember, past performance isn't indicative of future results. Dividend yields fluctuate. Always conduct thorough due diligence, understand risks, and ensure these ETFs align with your financial goals and risk tolerance. Consider reinvesting dividends to compound growth, or using income for living expenses depending on your life stage. This isn't just about high yield, it's about strategic income distribution and understanding each fund's nuances. This approach offers flexibility and financial control, turning your portfolio into a highly efficient income-generating mechanism. Power lies in disciplined execution, orchestrating individual components. It puts you in the driver's seat of your financial future. Building a weekly dividend portfolio offers a powerful path to financial freedom. Which of these ETFs intrigues you the most? Or what other strategies do you use for frequent income? Share your thoughts.